Something extraordinary just flashed across the screens, and if you blinked, you missed a moment that traders will be arguing about for the rest of their careers. Not because of a headline, not because of a policy speech, but because a number rolled over and kept going like the guardrails were never there in the first place. Silver just tore through levels that had capped it for decades, and it didn't ask for permission on the way up. For years, the market treated certain price levels like electrified fences. $90 was fiction, $95 was fantasy, $98 was supposedly reinforced with steel, concrete, and the collective willpower of every major bullion desk on the planet. And yet, here we are, watching prints above $90 as if that ceiling was made of cardboard. The move wasn't polite, it wasn't gradual. It was the kind of surge that leaves analysts quietly closing old charts because the old charts no longer apply. What makes this different from the usual precious metals pop is the violence of the rejection at lower levels. Over the past few weeks, every classic suppression tool showed up to the party. Paper contracts flooded the futures market. Volatility spiked at convenient moments. Financial media suddenly rediscovered all the reasons silver is just an industrial metal. Margin pressure appeared right on schedule. And still, the bids kept coming. Every attempt to shove price back into the box was met with a bigger hand lifting the lid. Now put yourself in the seat of a large short seller who built positions back when silver in the 20s and 30s felt safe. At $40, it's uncomfortable. At $60, it's a problem. Near $100, it's not a trade anymore. It's a balance sheet event. Losses stop being theoretical and start threatening capital ratios, credit lines, and executive sleep schedules. When price rises faster than risk models can adjust, you don't get tidy exits. You get scrambling, forced covering, and phone calls nobody wants to make. But the real engine of this move isn't just in New York or London. The center of gravity has shifted east, and the pricing signals coming out of Asia are acting like a magnet. While Western traders were still debating whether triple digits were possible, buyers elsewhere were already paying well above that. When a major physical market consistently clears at a premium, it sends a simple message to the rest of the world. Metal flows toward the higher price. Algorithms don't care about narratives, they care about spreads. And when those spreads get wide enough, capital moves fast. That dynamic turns price gaps into tractor beams. Buy where it's cheaper, sell where it's richer. Repeat until the gap closes or supply disappears. The problem for anyone trying to hold prices down with paper is that physical demand doesn't settle for promises. Contracts can be created with a keystroke. Refined metal cannot. When enough participants decide they want delivery, not just exposure, the leverage embedded in the system gets very real, very quickly. So why now? Why does a long, simmering tension suddenly snap on an otherwise ordinary trading day? Because markets have a habit of tolerating imbalances right up until they don't. For years, concerns about overleveraged institutions, opaque derivatives, and concentrated short positions sounded like niche worries. Then, price starts moving in a way that stress tests those structures in real time, and fringe risks become front-page risks. Once larger pools of capital smell vulnerability, they don't tiptoe in, they press. Hedge funds, family offices, macro desks, sovereign funds. The bigger players don't need a conspiracy theory. They just need a lopsided setup if they believe a crowded short is trapped. And the exit door is narrow, piling into the other side becomes a strategy, not a statement. Short squeezes are brutal precisely because they feed on themselves. Rising prices force covering, covering drives prices higher, and the loop tightens until something breaks or someone blinks. Lately, it hasn't been the buyers blinking. Now here's where the story shifts from dramatic to deeply unsettling. In a textbook risk-off environment, a vertical move in precious metals would coincide with tumbling equities. Investors sell stocks, raise cash, and rotate into perceived safety. That's the seesaw most of us were taught. Fear up, stocks down, confidence up, metals calm. But that neat relationship is starting to look like an artifact from a more stable era. Because at the same time, metals are screaming higher, equity indices are doing just fine, even celebrating. Tech stocks are green, broad market averages are pushing records. On the surface, it looks like prosperity and panic are holding hands. That shouldn't make sense. Unless the thing going up across the board isn't confidence, productivity, or earnings power, it's the unit everything is priced in. When both risk assets and safe assets rise together in a sustained way, it can signal that the measuring stick itself is shrinking. If the currency steadily loses purchasing power, then almost any hard asset, financial claim, or slice of future cash flow can rise in nominal terms at the same time. It creates the illusion of universal gains, even as real purchasing power quietly erodes. Your portfolio statement looks healthier. Your grocery bill disagrees. Economists have a term for the late stage of that psychology shift, a crack-up boom. It is the phase where the public gradually stops trusting money as a store of value and starts treating it like a hot potato. The goal changes from earn a return to dawn to be the last one holding cash. In that environment, flows into stocks, metals, real estate, and commodities can all accelerate together, not because fundamentals justify every move, but because holding currency feels like the bigger risk. That also explains why traditional stress signals can get distorted. Normally, a spike in one corner of the market forces liquidation elsewhere to meet margin calls. But if liquidity is abundant and credit is still flowing, participants can sometimes paper over losses longer than models predict. Fresh money chases momentum, passive flows keep allocating, and central bank backstops, explicit or assumed, dampen immediate contagion. The pressure doesn't vanish, it just migrates. None of this guarantees a specific endgame or timeline. Markets can stay illogical longer than commentators can stay calm, and dramatic narratives have a habit of overshooting reality. Still, when long-standing price ceilings shatter, cross-market relationships break down, and hard assets and equities sprint together, it's a signal worth studying, not dismissing. Something structural is shifting beneath the surface, and for now, the screens are flashing green, gold, and silver all at once. It feels exciting, surreal, and just a little unstable, like a party on the top floor of a building that's swaying more than anyone wants to admit. Maybe the music keeps playing for a while. Maybe the structure proves sturdier than the pessimists think. Or maybe we in the early innings of a monetary regime change that will be obvious only in hindsight. Either way, pretending this is business as usual is the riskiest position of all. If you trying to understand why everything with a ticker symbol suddenly looks like a genius investment, you have to zoom out from the charts and look at the plumbing. What we're living through isn't a tidy bull market driven by productivity or innovation. It's a tidal surge of liquidity with nowhere sensible to go. When that much newly created money hits the system, it doesn't politely sit in savings accounts. It runs, it chases, it floods. Right now, capital is behaving like people scrambling for the exits in a smoky theater. The goal isn't to find the best seat. It's to get out of the burning building called cash. Money is pouring into equities, into gold, into silver, into real assets of all kinds, because holding currency feels increasingly like holding an ice cube in the sun. The message from the market is blunt. I don't care what I own, just don't leave me in depreciating paper. That kind of everything rally isn't a sign of health. It's historically associated with late-stage currency stress. We've seen versions of it before. In Weimar Germany, stocks soared in nominal terms while ordinary people struggled to afford basic necessities. In Zimbabwe, the equity market posted eye-watering gains right before the currency effectively collapsed. On paper, investors looked brilliant. In real life, purchasing power was evaporating. The numbers went up. Living standards did not. That's the psychological trap. A portfolio that S up 10% feels like progress until your cost of living jumps 20% over the same period. You feel wealthier while quietly getting poor. It's financial sugar, a quick hit of euphoria masking long-term damage. The so-called gains are often just compensation for a unit of money that buys less every month. Nominal profits can hide real losses, and the distinction matters a lot more than most quarterly statements admit. So when you see green across the stock ticker, it's dangerous to assume it reflects a booming, resilient economy. Sometimes those green numbers are just the byproduct of massive policy stimulus, the monetary equivalent of adrenaline. It can keep the patient upright for a while, but it doesn't cure the underlying illness. Asset prices can levitate even as structural weaknesses deepen underneath. The smoking gun that this is a liquidity story rather than a growth story is the scale of money creation globally. Over the past couple of years, central banks and governments have opened the taps wide. Deficits once considered unthinkable have become routine. Debt servicing costs have exploded, and instead of cutting spending, many governments are effectively borrowing more just to cover interest. That new money enters the system somewhere, and financial markets are a primary destination. Think of it this way. Houses didn't suddenly become twice as useful. Stocks didn't suddenly start producing double the goods and services. An ounce of silver didn't wake up one morning with magical new properties. The underlying assets haven't changed that much. What's changed is the measuring stick. When the currency used to price everything is diluted, prices in that currency naturally rise. It's not that everything else is worth so much more, it's that the yardstick is shrinking. This isn't just a Western phenomenon. Major economies around the world have been expanding their money supplies aggressively in response to slowdowns, debt stress, and property market problems. When large systems inject trillions of new units of currency to stabilize growth, that liquidity doesn't stay neatly contained. It seeps into commodities, financial assets, and cross-border flows. Silver, gold, energy, and equities all become pressure valves for excess money. Meanwhile, in the United States and other developed economies, official rhetoric about fighting inflation sits awkwardly next to persistent fiscal expansion. Running massive deficits year after year means new debt issuance, and ultimately more currency creation to absorb it. Every time large sums of new money are pushed into the economy, the purchasing power of existing savings is diluted a little more. It's a subtle tax that doesn't require a vote. Emerging markets offer a glimpse of how this dynamic can play out when it accelerates. Countries that have experienced rapid money supply growth often see stock markets surge in nominal terms. On the surface, it looks like a golden age for investors. In reality, local currencies weaken, import costs rise, and everyday expenses outpace wage growth. Asset prices rise, but so does the cost of survival. The scoreboard says record highs. The grocery bill says otherwise. All this liquidity creates a strange distortion field. Traditional relationships between asset classes start to wobble. Signals that used to mean one thing begin to mean something else entirely. Investors check retirement accounts hitting new highs and assume skill is the reason. Sometimes it's not skill. It's the monetary treadmill speeding up beneath their feet. You have to run faster just to stay in place. In this environment, the surge in silver stands out as a particularly blunt message. Unlike a tech stock with a compelling growth story, silver doesn't pitch a vision of the future. It just sits there, inert and shiny, quietly reflecting the value of the currency used to buy it. When it takes dramatically more dollars to purchase the same ounce, it is less a story about silver and erroneous brilliance and more a commentary on the dollar's dilution. It's a thermometer, not a hype machine. The broader market, by contrast, can behave like an overly optimistic doctor insisting a 105-degree fever is a sign of strong metabolic activity. Rising equity indices and a flood of liquidity don't automatically equal real wealth creation. Sometimes they signal the opposite, that debt, stimulus, and currency expansion are doing the heavy lifting. As this wave of money sloshes around the globe, it's also creating curious divergences. Some of the darlings of the last decade aren't responding the way many expected. One of the most interesting quiet spots in all this noise is crypto, especially Bitcoin. For years, the narrative was straightforward. If fiat currencies weaken and inflation fears rise, digital scarcity should shine. Bitcoin was marketed as digital gold, a hedge against monetary excess. And yet, in a moment when gold is breaking records and silver is sprinting, Bitcoin's performance looks comparatively subdued. That's not what the standard script predicted. If this were purely a clean inflation trade driven by currency debasement alone, you might expect all hard or supply-constrained assets to move in lockstep. Instead, the market appears to be differentiating between forms of perceived safety. Part of that may come down to liquidity plumbing and investor psychology. In periods of stress or uncertainty, larger pools of capital often gravitate first toward assets with long histories, deep physical markets, and established regulatory treatment. Gold and silver have thousands of years of monetary history and massive above-ground stocks. Bitcoin, for all its strengths, is still relatively young and can trade more like a high volatility risk asset when conditions tighten. There's also the uncomfortable possibility that in a true currency confidence event, some investors prefer what they can hold, store, and settle outside digital rails entirely. That doesn't invalidate the long-term thesis for crypto, but it does suggest that in the early phases of a liquidity-driven repricing, traditional hard assets may get the first wave of flows. Whatever the precise mix of reasons, the divergence itself is information. It tells us this isn't a simple one-factor market. It is a complex transition where old relationships are breaking and new ones are forming in real time. The map investors relied on for years, tech up, metals quiet, liquidity up, crypto rockets, is being redrawn. We're in a period where price action is sending louder messages than official statements. When money supply growth, debt expansion, and cross-asset rallies all converge, it's worth asking not just what's going up, but what is my measuring stick worth? Because in the end, wealth isn't about bigger numbers on a screen. It's about what those numbers can actually buy in the real world, and that S, the part of the equation, getting harder to ignore. Let's start with a simple observation. When investors get nervous about the future, they usually reach for things that have weight. Not metaphorical weight, actual weight, stuff you can drop on your foot. That instinct is flaring up again, and it's telling us something important about the moment we're in. What S unfolding in the metals market doesn't have the feel of a speculative tech frenzy or a social media-driven squeeze. This feels more primal. When supply chains look fragile and currencies look overworked, capital tends to retreat to the physical world. You can't smelt a cryptocurrency into a circuit board. You can't wire a solar farm with an NFT. Digital assets may represent energy and code, but silver represents conductivity, manufacturing, and defense hardware. When the world gets tense, practicality starts to outrank elegance. That shift in preference helps explain a strange divergence. For years, the narrative said that in any serious currency scare, digital scarcity would lead the charge. Yet right now, traditional hard assets are acting like they've just been handed a triple espresso, while some of the flashier digital hedges look oddly subdued. It's not necessarily a verdict on technology. It's a reminder that in periods of stress, long track records and tangible utility carry a psychological premium. Big money appears to be making a calculated rotation, not out of innovation entirely, but away from assets perceived as risk-on and toward assets seen as foundational. 5,000 years of monetary history still counts for something when confidence in modern systems wobbles. This doesn't look like a tech bubble inflating. It looks more like the early innings of a commodity-driven cycle, where the physical inputs to the global economy reclaim center stage. And that brings us to a number that's starting to matter a lot more than people realize. While many traders are fixated on the round figures flashing on Western screens, another price signal across the globe is quietly setting the tone. The celebration over silver flirting with triple digits in New York misses the bigger story. Elsewhere, buyers are already paying meaningfully more. That gap isn't just trivia for market nerds, it's a live arbitrage signal. In theory, if one major market prices an ounce of silver at around $90 and another consistently clears closer to $111, traders should rush in, buy low, sell high, and close the spread. In well-supplied, frictionless markets, those differences disappear in seconds. The fact that this one is lingering, even widening at times, suggests the pipeline between paper pricing and physical availability is under strain. When a premium like that persists, it acts like a vacuum. Metal has a strong incentive to flow toward the higher bid. Producers, refiners, and large holders aren't sentimental. They follow price. If one region is willing to pay double-digit percentages more for the same bar of metal, supply naturally migrates in that direction. Over time, that can leave lower-priced markets increasingly dependent on derivatives and promises, rather than readily deliverable inventory. For heavily short participants, that's a nightmare scenario. Covering a short position is straightforward when metal is abundant and sellers are relaxed. It is much harder when physical supply is being drawn away and the marginal seller demands a higher price. The longer the price gap persists, the more pressure builds on anyone betting that the lower price can be maintained indefinitely. Markets have a way of forcing convergence, sometimes gently, sometimes with a gap that makes everyone spill their coffee at the open. Zooming out, this all feeds into a broader diagnosis of what's driving the everything rally we were seeing. The uncomfortable truth is that much of the upward motion across asset classes has less to do with explosive real growth and more to do with an ocean of liquidity sloshing through the system. When central banks and governments expand money supply aggressively to manage debt loads and economic slowdowns, that money doesn't sit idle. It looks for a home. The result can be a strange spectacle: stocks climbing, metals climbing, real estate firming, all at once. On the surface, it feels like prosperity. Underneath, it can be a sign that the unit of account is being diluted. If more currency units are chasing a relatively fixed pool of real assets, prices in that currency tend to rise broadly. You feel richer because your portfolio is bigger in nominal terms, but your purchasing power may be treading water or even slipping. That's why rising markets don't automatically equal a healthy economy. Sometimes they signal that policymakers have chosen to cushion every slowdown with more stimulus, more deficits, and more monetary expansion. It is the financial equivalent of turning up the music to drown out a strange noise in the engine. It works for a while, but it doesn't fix the engine. Against that backdrop, silver's surge looks less like a quirky corner trade and more like a barometer. It doesn't promise future earnings or platform dominance. It just reflects how many currency units are required to obtain a tangible, useful material. When that number climbs rapidly, it's often a commentary on the currency as much as on the metal. None of this means the sky falls tomorrow, or that every rally is fake. Economies are complex, and innovation still creates real value. But when long-standing relationships between asset classes break down, when physical commodities command persistent premiums in key markets, and when liquidity drives broad nominal gains, it's wise to pay attention. Investors, savers, and businesses all face the same challenge in such an environment: distinguishing between nominal growth and real wealth preservation. Holding only cash when money supply is expanding quickly can feel safe, but gradually erodes purchasing power. Chasing every hot asset without regard to valuation can be just as dangerous. The middle path often involves focusing on quality, durability, and balance, assets and strategies that can weather both inflationary pressure and volatility. The key takeaway isn't panic, it's awareness. If prices for essentials and hard assets are rising faster than incomes and productivity, that's a signal about the monetary backdrop. If physical markets are pulling supply away from paper markets, that's a signal about trust and availability. And if traditional hedges and modern ones are behaving differently, that's a signal that investor psychology is shifting in real time. We may indeed be in the early stages of a regime change in how markets interpret risk, safety, and value. Those transitions are rarely neat. They're noisy, emotional, and full of cross-currents that make old playbooks unreliable. But they also reward people who stay flexible, think in real rather than purely nominal terms, and resist the urge to believe that rising numbers on a screen automatically mean rising prosperity. In the end, markets are just giant voting machines for confidence. Right now, confidence in physical scarcity and tangible utility appears to be gaining ground on confidence in pure abstraction. Whether that trend accelerates or stabilizes will depend on policy choices, supply responses, and human behavior, the usual cast of unpredictable characters. But one thing is clear. The signals flashing across metals, currencies, and global price gaps deserve more than a casual glance.